As 2014 gets rolling, it's probably time for investors to temper their expectations. I'm Jack Otter, editor of BARRON'S.com. I'm here with Brian Rogers, who's the Chief Investment Officer, also the Chairman of T. Rowe Price, and a longtime Barron's Roundtable member. Could you give us your outlook going into 2014 after a marvelous 2013 for stock investors? You think maybe it's time to stop wagging our tails quite so fiercely?
Well, I think, Jack, investors had a very good experience last year, equity investors. Equity markets really outperformed all other markets, and investors were pleasantly surprised by the returns. As we get into 2014, I think we face the prospect of a moderate growth economy. Companies will have good earnings performance. At the same time, after the last 2 years, valuations are stretched to the point where I believe it makes sense for investors to have more subdued expectations. So I think it could be a reasonable year this year, but it won't be a 30% year again, and investors would do well to be a little bit more conservative in terms of their approach.
So we won't see multiple growth. Anything you see ahead for stocks is probably going to come from better earnings?
Yeah, I would bet against PE expansion in 2014. We've had a fair amount of that over the last couple of years. I think you'll see growth coming from revenues, earnings, stock buyback activity, which I think will continue, and investor flows will continue to be positive and supportive of the equity market, but I think it's tough to make a case for PE expansion in 2014.
Revenues, of course, have been the problem. Companies have found ways to increase earnings, but their revenues haven't been increasing at the same rate. Will that finally pick up? Do you see economic reasons for that to improve?
Well, it may pick up somewhat. I think it's difficult to make a strong bullish revenue case in a 3% gross domestic product type environment. So I think we'll see a bit of a top line pickup this year, but you're right, it has been a big challenge. I think it will continue to be, and I think investors will have to benefit from squeezing earnings out of a moderately growing revenue stream.
Okay, so given this kind of an outlook, where do you think are stock opportunities for investors?
Jack, I think it's a more challenging environment this year, and it's tougher to come up with a wide range of investment opportunities. I'm looking at companies going through their own transitions. I'd mention two: Applied Materials, which is in the middle of a merger with Tokyo Electron. So you have a big successful American company merging with a successful Japanese company, and the synergies and the revenue benefits and earnings potential of that combination will be very profound over the next couple of years. Consul Energy is a coal and natural gas company. It has been divesting coal assets and reinvesting in the higher growth natural gas business, and is a company selling well below asset value, and we think that offers good upside potential as well.
How much of their business is coal, and is there any future for coal, at least in the near term?
What Consul has done is sell some of its underperforming coal businesses.
Understandably. And
kept its higher value added businesses. And so the mix is shifting from basically 3/4 coal, 1/4 gas, to basically it'll be 50-50 in a year or two.
And what kind of valuation are we looking at there? I suspect it's a little bit beaten down given its coal exposure?
Given its coal exposure. As you know, many natural gas companies and shale gas companies have been very good performers. The company's trying to transition into one of those, and we think the value is somewhere north of 45, and the stock is currently 36, 37.
Thanks very much, Brian.
Jack, good to be with you.